When analyzing market structure on a price chart, it is crucial to understand what that pair is doing, identify the current phase, and recognize when the pair's structure shifts in a different direction. So is a currency pair trending up or is it trending down? So are we putting in lower lows, lower highs, higher lows, higher highs? Are we ranging? So a range is when the market stays within two price points, not moving up or down. Is the price impulsive, corrective? So we will know what a pair is doing by identifying the structure. So as we just said, what we have here is an uptrending market. So in an uptrending market, we will get higher highs and higher lows. So as we see, we have a high here and a price pullback. Now, as soon as we get a price break above this high, it confirms this to be the higher low. So all the time, price is trading within this high. Below it, we haven't got a confirmed higher low until we break above. So once we break the structure, this is the most recent higher low, and that's a higher high. We pull back higher low. We then wait for a new higher high, which confirms the higher low, and then higher high, higher low, higher high. Now, the same is in a downtrending market, but it's flipped, so it's the opposite. So we will get a low, a pullback, and this lower high is not confirmed until the price breaks this low here. So we get a break below, which confirms the lower high, lower low, pullback, lower low, confirming the lower high, lower low, confirming the lower high. A higher high is not confirmed until we get a break of the structure of the most recent high, and vice versa for a downtrend. And let us look at this on the charts. So starting from here, the price is pulled back and we have broken this first low. So we have made this low, which we could say kept going lower until here. This is when we got a pullback. So this low, this whole leg down broke below here. So we can see it has broken this low. So we have a lower low, then we have a lower high. So we can see price pulled back, which is tapped into an order block, which would be more visible on a lower time frame. So the low that we need to be broken is here, which we can see price pulled down to here. This is one continuation leg to the downside, then price pulls back, but this is not confirmed as a lower high, but we can see what price done. It has tried to come down, but we failed to break below this lower low, and instead we come up to test the lower high. We then pull back, but then we eventually break it with this move, this impulsive move that breaks the structure of this lower high. So as the lower high was broken and we didn't get a lower low, our bias has flipped from a bearish market to a bullish market because we can see the lower high is broken. Price then pulled back and we get higher low, which we can classify as the highest point. So we can see this is a new higher low because it broke above this highest point here. We then pull back and make a higher high. This is now confirmed as the most recent higher low. Now we have a higher high, higher low. Price then pulls back. We consolidate for a good few days here. We come up to test this high, but we don't break it until here. So where would we classify the higher low? Well, technically the lowest point is here, so we can mark this as a higher low. Bearing in mind, we have areas here that we can look to be getting long from. This is the higher low. We then get a higher high, which the highest point is surround here. So that's the most recent higher low, higher high, higher low, higher high. This is confirmed once we get this impulsive move up that broke this high. Now we could say that this we had is an impulsive move up that made the higher high, pulled back, and then we made this higher high. We came down to test it, we pulled off, and then we broke it. So essentially, we had a little break of structure, but this could be grabbing liquidity from people who are in longs on this higher low with stop losses. We didn't quite tap into any sort of point of interest. We just sort of pushed up from here, but the lowest point is here, and then we do put in a higher high and a higher low. After a break of structure, we have a higher high, and next we can confirm our higher low, and to higher low is the lowest point always. So we have here again a higher low and a higher high. Of course, there are several breaks of structure in the lower time frame, but this is the overall how to mark the break of structure. There are a few different variations of market structure breaks that I want to cover. Now, it is important that we choose one of the following market structure breaks as we go and stick with it. So the first type is going to be where price breaks structure with a candle body closing below the candle body low and not factoring in the wicks. The second type, which is what I personally use and one that is the most popular, is a candle body close below the candle's wicks. The third and final type is a candle wick close below the candle wicks. In my own experience, this type is the least reliable out of the three, as it does not really show us any true break of structure. So looking at some examples of break of structure, what we can on 1 hour, we had a break of structure here, we had this higher, we had a little bit of a range, and then this candle broke structure and we got a wick, but we did close above. And then we can see price pull back into a bullish order block, which is here, before we see some huge momentum to the upside. Now, as we broke above and closed above the structure, this would be for me a valid sort of trade to be looking at. As we come back into this 1 hour order block, which we can refine on a lower time frame. But if we look at some of this example here, we can see we had this bit of a consolidation range. We pushed down ranged. We had a low price come down, looking like it was going to break this low. We wicked it and closed above, and then we can see price then reversed to the upside. So for me, this wick to downside is just grabbing some sell side liquidity from this equal lows before they reverse price up to this high here. As we can see, we also get a wick above this high, which is taking some more buy side liquidity. Price then reverses. We put in a new low, and then we pull back, and then we have a huge wick. So we, at one point, price was down here, and then we actually closed bullish. So we pushed down below this low and then closed above it. If we look left, we can also see that this wick tapped into a bullish order block, perfectly mitigating before continuing. So this is why this is definitely not a valid break of structure for me, because this is just generating liquidity, rebalancing this impulsive move here, tapping into a bullish order block that has yet to be mitigated before reversing price to the upside. Now, another example on this 1 hour, we were putting in lower lows and lower highs all the way down here. We can see at this point here, we had price put in this lower low and lower high, because we can see this is the lower low that broke this low here. So then we can see that price impulsively broke the structure to the upside. Now for me, this would be a valid break of structure, because we can see we had a candle body that closed above the wicks of this lower high. So once we got this, we can see we left an imbalance as well. We have a momentous move showing us a change in market structure. We can then take the last down candle as our order block, which we can then obviously refine down to this candle here, because the momentum came in on the next candle, which broke structure. So we can see after that, we did get a good day or so off a range. Buy market, we did break of structure again. So we have done break of structure here. Price did come down quite impulsively into that level. We did range. This is building some liquidity, which is more seen on lower time frame. We have equal lows, price come in, tapped into our order block, which we can refine on a lower time frame. But this is what we can be looking at, and then we can see price reacted from this order block, rebalance bid of price, and then we can see the impulsive move to the upside from here. Now I want to get into looking at how price breaks the structure. So when we are looking at structure breaks, it is very important to note how price breaks that particular piece of structure. So what I mean by this is it will be breaking structure and truly switching from a bullish to bearish market or vice versa, bearish to bullish, or I will be breaking a structural low high, grabbing liquidity, tapping into an unmitigated order block to then see price continue with the overall trend, whether that be bullish or bearish. This is why it is important that we take note of how price breaks, because it will give us a really solid idea of what price is actually doing and where it's likely to be heading. So in this first example, it is going to be our 1 hour. So we can see we have put it in higher highs and higher lows all the way up. Now this move down broke the higher low. So we have a broken structure. So what we are going to be assuming in this example is that this down move here is a calm and corrective break of structure, meaning there is not much momentum behind it. It is just a break of structure with corrective and low momentum candles. So when we get this, we are going to view this as a common corrective break of structure, meaning it's very likely that price is coming down to sweep liquidity and tap into an unmitigated demand zone that was previously created, because once we were making this higher highs and higher lows, we are breaking structures to the upside, which is creating demand levels and order blocks. We may see something that is left behind, an untested, unmitigated imbalance left behind as well. So this breaking structure could be grabbing liquidity from anyone who is in the bias and trading stop losses at the lows, because we know that there is liquidity at every low and high in the market. So this could be a break of structure, taking liquidity, tapping into an order block, which is unmitigated, before continuing with the overall bias, which is bullish. So this would be our 1 hour demand, the price tapped in. Now, what we can see from this on a lower time frame is a 1 minute perspective. So this blue box here is a 1 hour order block. So the move that comes down that break of structure on 1 hour will look like this on a lower time frame. So we would be seeing lower lows and lower highs. As price taps into the 1 hour demand, we can look for where the lower low and the lower high. Well, we have a lower low here, and this is the most recent lower high. We can look for price to break of structure. That will create a bullish order block, which we can look to get long from. Now with targets, we can look for previous 1 hour highs, because the anticipation for us is to still see bullish order flow. We have swept liquidity, so we want to see price put in new higher highs. So we have the same thing as corrective one. Higher highs and higher lows. This is now going to be an impulsive break of structure. So an aggressive break of structure, meaning we would see some large momentum candles, which would ultimately leave behind a price imbalance. So on this down move, once the price breaks structure, we can classify this as the market shifting from bullish to bearish, because we have seen large momentum. So the break of structure, once we get that, we form a supply zone and order block, which we can look to get short from, as we can anticipate a pullback into that zone, and for future lower lows and lower highs to take place. So once we get an impulsive break of structure, this will be our supply zone. Somewhere up here, we may have areas below it which we can refine on a lower time frame. But for this example, we are going to be saying this is where we want to get short from. So again, we can look at the 1 minute perspective. This is what we could look to see as we tap into the 1 hour supply. So price is forming higher highs and higher lows coming into it. We want to see a nice break of structure below the most recent higher low, which will give us an order block, which we can look to short from, and the same goes for targets. At a minimum, as we have switched our bias from bullish to bearish, we want to be looking for price to put in 1 hour lower lows and lower highs. So this 1 hour low would be the most recent low. We want to see it take out this low. So this is a good place to target for a first target at a minimum. So we shouldn't be afraid of buying before the longer term sell. So what I mean by this is, let's say price breaks structure to the downside, as we can see here, whether that was a calm or aggressive move that breaks of structure the structure. We can still look to take longs from an area if there is an area to go long. So if we have a demand level which was untested, then depending on how the lower time frame confirmation is showing us, as we come into this level, we can take a long from here where we can target a supply zone which was recently created from this break of structure to the downside. So we buy from here and target up there before a longer term sell, which we can then expect for price to make new lows and then lower lows, lower highs from there. Now this move from here, as we can use the lower time frame to our advantage, we can obviously get in with a very tight stop loss, and this move from demand to supply zone could be 30 pips, 20 pips, 60 pips, whatever. We can still make some nice percentage in this move here before we look to sell. So we can buy to sell. Now, the reason why this is also higher probability, because once the price comes into this level, we are essentially mitigating this move, taking liquidity from anyone who is a buyer, or even trading some form of breakout in the structure break. Whatever the case may be, liquidity is being taken. So people are getting stopped out to then see the price come into a supply zone. So basically, it clears the way for liquidity, and price can tap into a supply zone, and then we can shorten from here. So this move has now been mitigated. In this demand zone, we have seen a push off. So we can now classify this as a completed sort of move. We have pushed off once the price comes down. There is not much real reason why this demand zone will hold again, because it has been mitigated already from this move here. So we can see prices come down and take out lows. An example of buy to sell, or in this example, is going to be a sell to buy we are going to talk about when we break the structure. We can sell, and then we can look for a longer term buyer from an untested area. If we look at the price, we had, this high in price come up. We see a bit of a range. We did form equal highs, and this is the high that took some buy side liquidity. So once we had this high, we had a higher low here. So range, and this is the move that broke to a new higher highs. This is the higher low. We can then see the price after sweeping buy side liquidity. We came down to a break of structure, and the candle closed below. So it is a valid break of structure. This is also seen on a lower time frame. The 15-minute, 5 minutes where we did close below, but this for me would be on the 1 hour. It's a calm break of structure as we have closed below. We can still look to sell from this supply zone before a longer term buyer from this area's down here. So once we break of structure, we have the last up move before the down move that breaks the structure. We can then also refine it from this last up move to this candle here, because we can see this candle has not engulfed the order block. So this is our supply zone and order block, which we can look to get short from. So as we came down, we did get some wicks, which for me is just taking liquidity from this higher low before this one. So we can see we had this wick that came down. So anyone who is in buys, who is holding from this uptrend, would likely have stop losses at this low. So we can see the price come down to take that liquidity, reverse, and then reverse again. So this happens every single day. So here we can take a sell on a lower time frame. So once we tap in, we move to a lower time frame, looking for reactions and a break of structure, which leaves imbalance. So once we tap in order block, we need to look left. We could look to see if we have any demand levels that have been unmitigated and left for a later date. So let us have a look. So we had this higher high and a higher low. Price comes up to form these equal highs, and then we see some huge momentum that essentially broke this high here. So we can mark it as a break of structure. We wicket it, but we can see this is a range, and then we expand it out quite momentously, leaving behind an imbalance. So for this example, I'm going to put on this demand level. We do have an order block, so this is order block, but let us just mark on the actual range from the high end to the low. So as price comes in, we can note that we have seen some heavy momentum coming into this level. So price has taken out this low, rebalanced this move that was made previously, but price is impulsive. So what we could do on a lower time frame is we can wait for the price to slow down, show us they actually want us to respect this area, and actually go long from here to potentially back up to these highs. But if we get another candle, something like this that just completely destroys this demand level, then it doesn't hold. So we can just classify it, or we can just deny it and just move on and look for bearish sort of structure and look to get short. But the next candle, I'm not going to go lower time frame and look at the entries, but we see we wicked below it, but we closed back up. Now for me, this is not invalidating the demand zone because it is about how it breaks. Is it breaking momentumally, or is it breaking correctively with wicks? And we can see it is breaking with wicks. So on a lower time frame, firstly, when we get wicks, if we get a wick on a 1 hour, it will be an order block on a lower time frame. So wicks just show us order block basically on the lower time frame. So there are entries here on a lower time frame, like the 5 minute or the 1 minute, which I won't go into, but we can see what happens next. We do respect the demand zone and we do correct, but then we can see we come up to rebalance this candle here from wick to wick. We then break above it, and we can see then do come up to previous highs and back up to test this wick here, which we know as an order block on a lower time frame. And that's where the price then reverses again. So we can see this wick up here that we know is an order block on the lower time frame, and look at how the price respects it. Now we do wick above it, which is likely because we want our price to generate liquidity before reversing, but ultimately it respects it, and then we break of structure back down to the low. So this is where the price currently is, but this is just the concepts of buying to sell, selling to buy. Now, as we have already tapped into this demand zone, it is likely we could now see lower prices and we can look for sells. The last piece of advice I would like to give is that mastering market structure is like reading the language of the charts. The more fluent you become, the smarter your trades will be. And if you found this helpful, give this video a like, subscribe for more Forex tips, and drop a comment below on what are your views on this market structure strategy. I have talked a little bit about order block in this video, but if you want to get a bit more understanding about order block, be sure to watch this video. That was it for this market structure episode, and see you on the next one.